Hello and welcome to Pro Trader Strategies market commentary for Thursday, August the 13th. My name's Eric Wilkinson, and yes, you very well may recognize me from mainstream media where I've talked about the economic data, the geopolitical environment, and how that comes in to impact the overall market with my market analysis. And I do the same thing in these daily market commentaries, but I'm going a little bit further and layering on option strategies I find based on some guidelines that I've come up with and I share with you in webinars over my 25 years of trading. We really streamline the process for you so that you can find the right option strategy for any given assumption that you come up with. It's not just going out there and picking a strategy out of a hat. It's really digging into the devil of the details, and I've streamlined that process for you by a step-by-step process that you can find out whether or not a option strategy is great for that market assumption. All right, let's get on with the overall economic data. We got a lot to talk about today, as we did yesterday. I ran a little bit long yesterday, but we got unemployment claims here in the United States coming in below 1 million, which is good. 1 million is not good, don't get me wrong, but for this coming out of this environment, seeing it go below 1 million on unemployment claims is good. So 963,000 expected to be 1,120,000. They did revise last month's number up, just albeit slightly by about 10,000 there. So not a big adjustment. Importer prices coming in at 0.7%, expected to be 0.6. That's not really surprising. We already saw it come up in the PPI, CPI data where those numbers are starting to ratchet up. So of course we're going to start seeing prices rise. Natural gas storage is coming in at a build of 58 billion cubic feet, expect to be 51 billion cubic feet. Later on today, we got a bond auction, so keep your eyes out for that. That could be a little bit of a something to churn the pot there. And tomorrow we get retail sales. Now everybody has been really celebrating the retail. Even the brick and mortars have been doing pretty decent. They've pivoted with curbside pickup, stuff like that. And it's going to be interesting to see, because I've been talking about this for quite some time, that people sitting at home are going to want to shop, and this was a whole stay-at-home trade. Well, now that I've really been thinking about this, we're starting to see this happen with people staying at home. And we've talked about this in the past with crude oil, where I want to see lower prices in crude oil because that allows people to spend that money elsewhere. Well, when they're staying at home, they aren't spending that money on the gas that they're traveling from work and everything else. So think about how much money people that have been working from home are saving on gas or transportation spending, and that is probably going to be spent elsewhere. And my thing is it's probably going to be spent in the retail sector as people have that extra money in their budget, or they're throwing it into the stock market, which we're actually seeing a lot of with some of the younger generation really starting to get involved, which is a great thing for financial literacy. I think that it's a good thing for our future outlook of our younger generation. All right, something that got missed in a couple of generations as well. All right, so crude oil, it is off just a little bit, punching up against that 200-day moving average. But right here in these mid-40s, it just doesn't feel like it has any oomph to go any direction. There's just no catalyst to drive that market. Bonds completely unchanged right now on the day, holding on to that 50-day moving average. Again, we are talking about it wanting to stay between 177 and 183. That is kind of that sweet spot. The bond auction today is going to be a big thing to kind of determine where the overall market is finding interest rates as well. Now, something else, we've talked about this move higher in the overall points of control for this market. I've been talking about it for quite some time, that it was going to move up to that 180 handle. Well, it's right there at the 183 handle, as we can see. 181, I should say. So right there, we've got that volume node moved up, where that's where the time and volume has been spent. Well, we can see time has been spent there. But the volume is another acceptance of value, which is right here. And I do expect this to move up relatively soon. We can already see that that volume node is starting to peel out. Why hasn't it moved? I'm not quite sure, other than there is a lot of volume being spent down here so far. But I do expect this volume node to move higher, which is acceptance of price and value at those levels. So right in and around where I've been talking about it, that 180 handle is the sweet spot. And I've been talking about that since way back here, where that's where I thought that the market should go. And we did get a little overextended to the downside, which interest rates, I was saying, aren't going to start going up. Remember, it's an interest rate play where we got the interest rate in the dollar, and it's a teeter-totter. And if interest rates go up, that means price goes down, right? And I do not expect to see interest rates going higher anytime soon. And despite the fact that this little move there is kind of signaling higher interest rates, I do think that the bonds are going to kind of ping back and forth between those two levels I just talked about earlier, 177 and 183. So markets kind of playing that, but a lot of this is going to be a push and pull as we are seeing the equities start to make some moves higher, and there is going to be people pulling money out of assets like the bonds where you're just not getting any yield at all. So it's kind of a chase to find quality there, and they're going to be peeling out of that and into other markets. Gold making a move higher here by $11 after settling just slightly above this Fibonacci that I've been talking about. This is going to be the star Fibonacci right here. That is the key level, where that is that high level we talked about back from the beginning of the Great Recession. And I think that the market is going to try to hold on to this level as we are talking about creating more monetary policy. That means printing more money. That means weakening more dollars. That means that if this is dollar correlated and the dollar goes down, the value of this drives higher, okay? That is an aspect that is theoretical. I mean, yes, this is, it is true, but if, we found more supply of gold, then that could counteract it. But right now, we know that there is limited supply of gold out there. Yes, we are continuing to pull it out of the ground, but there's just, at some point in time, it's going to be much more difficult to find. Anyway, all of that being said, gold is dollar correlated. Dollar goes down, value of this goes up. So same thing with this. It's the dollar of this, and I don't know how you draw a gold nugget. I guess I probably should do it in yellow, the gold nugget right here, right? As the teeter-totter goes, dollar value goes down. We've got a teeter-totter here. The value of gold starts going up, right? It's completely inversely correlated there. Not completely, I shouldn't say, but it is inversely correlated. All right, VIX coming off, and people talking about there's no volatility out there. Everybody is very complacent right now, and I think that they are. I don't think that there is a lot of put buying for protection at these levels. But something that's funny to note about that is when everybody's talking about this on mainstream TV, that you can see that in the past, we are slightly lower than what we were normally seeing at highs, but you can also see that, generally speaking, up into the 20s was really where we would consider that as high volatility. The teens was normal volatility. Well, and you remember me talking about let's get back into the teens so we can start selling some volatility. Well, if we start getting back into the teens right now in this type of environment, it's going to be an opportunity to be buying option premium. But right now, it's kind of in and around that area in the low 20s. I think it's going to hold on to the 20s. I said I think the volatility is probably going to be here for the remainder of 2020 anyway. So the market is at relatively low since the start of this pandemic, but elevated in historical terms. All right, we've got the Dow Jones Industrial Average moving higher today by a whole 2 points, just slightly in positive territory NASDAQ is moving higher quite nicely by 129 points. A lot of this led by the tech sector coming out. Cisco did really bad on their earnings. I'm glad I didn't play them. They're dragging on the overall markets. And E-mini S&P is up 10 points on the day. So really people going to the getting away from the blue chips again, which is what I was kind of expecting to be where the flight was, and out of some of these tech high flyers and into the more blue chip stocks as an opening up trade. Well, that's kind of on the shelf right now. It's not really following through, but I'm usually early on those kind of calls. E-mini S&Ps, pretty unchanged. We got good economic data right out of the numbers. We saw that we got a boost there, but now really starting to quiet down overall. And tomorrow, looking forward to those retail sales number. A couple of things I want to talk about. Yes, I'm talking about PENN again. It's just top of mind all the time. Another new all-time high, almost at $55. Why? Because these analysts, they're so brilliant. You know, we talked about the analysts back on, June 8th. And, the market was really rallying nice. And then we've got the Deutsche Bank guy coming out and saying, oh my gosh, PENN is overdone to the upside. It's should be valued at around 22. And yeah, people started listening to that, some of the Wall Street guys and everything else. But, I'm like looking at Portnoy and Barstool Sports and saying, these guys are crushing it. They're PENN National wasn't even on my radar before Barstool Sports got involved, or before they got involved with Barstool Sports. And now I think that they're probably a household name as much as somebody like Wynn and Las Vegas Sands. It's crazy. And that's what kind of media Portnoy is driving. So basically yesterday, Goldman Sachs came out and Stephen Grambling or whatever said that he increased this to a buy and a price target of 60. All right, so markets taking note of that and starting to move, and basically they're saying it's because they are able to leverage Barstool Sports to enable customers-based content and creating an engine to drive them to their gaming. All right, and Barstool Sports is coming out with their own gaming app too, so I don't know when that's supposed to be released, but that's going to catapult them even further. It's going to help PENN overall. It's going to help Barstool Sports dramatically, but it's going to help PENN also. So PENN, I just had to bring this up because these analysts are just like, they're analysts. I shouldn't really beat on them too much. I mean, I got offered a couple of jobs as an analyst and came out with like Zillow and I can't remember a couple of the other ones. I was like, my tagline was Zillow will go. And that was when Zillow was basically in the teens and it's done nothing but just blast off to the upside. Let's just take a look at Zillow since I'm talking about it. I don't know. I haven't looked at Zillow in forever, but it's the one that I was talking about. Yeah, so that was back when Zillow was in the teens and I was like, Zillow will go. It was just like the housing market and online housing is the future of it. It was when I was starting to look for a house and it was like this platform is awesome. I don't have to talk to a realtor necessarily. As a matter of fact, I bought one of my houses by looking on one of these platforms. The realtor wasn't even showing me the house. I looked at like 10, 15 houses. The realtor was like getting annoyed that I hadn't picked a house yet. And I was like, because you're not showing me the houses I want. I found one. Let's go take a look at it. That was the house that I bought. Anyway, these kind of platforms, especially right now, as a matter of fact, will probably do very well with a lower housing inventory. People are going to be needing to look a little bit longer and a little bit harder for their house. Well, Zillow is going to benefit from that. So anyway, that's my rant on that one. And then something to note, with all of these stock splits, we've got Apple doing I think it's a 4-for-1 Apple split, right? So Apple, Apple, I think is doing a 4-for-1, I probably should say 4-for-1, and Tesla is doing a 5-for-1 split. who else is just thinking about, oh, does that mean what's Google going to do? I mean, Google's an expensive stock. What about Amazon? All right, Amazon. Those are questions that we're going to have to keep an eye on these splits, because people want to own these stocks. And yeah, some people say, yeah, you can own a fractional share. Who wants to own a fractional share, right? You want to say you own the stock, and a fractional share just isn't as sexy as being able to go out there and buy a full share, or being able to buy 100 shares of the underlying, all right? That's what the default is over there. I don't even, you'd have to call a broker, and it probably cost you almost as much as the stock on buying a fractional share out there. So I think that these guys are going to be the next ones to come in. And what does that say for NASDAQ? This is the ticker symbol for NASDAQ stock. I don't usually show this too much, but because I don't trade it. But NASDAQ, I'm not saying is going to do a split, but if Apple does a 4-for-1 split, Tesla does a 5-for-1 split, Google does a split, Amazon does a split, well, I think it's going to increase the volume on these exchanges. Not only are more retailers going to get involved, but it's probably easier if more retailers are getting involved, for the high frequency to get in there and start trading. That increases volume on the platform. Also, it increases their data. And believe it or not, NASDAQ probably makes as much or more on their data sales than they do on the transactional values on their platform. So keep your eye out for that. If more people are able to come into this market, more retailers, then they get more data. That helps them out on their bottom line. So if you're looking for a long-term trade, this might be one of those to add to your portfolio because of all of these stock splits. That's kind of going to be the new thing, I think, as the people are trying to get more of these newer retail traders, the people that are millennials, maybe not have a ton of money. We always talk about in my webinars how people are struggling with margin in their portfolio. You can use the options in order to take advantage of that. Well, when these guys are lowering their overall value of their stock by splitting, then, and when I talk about the value of their stock, I'm talking about just the price of the stock. They lower that overall value, make it more accessible for people. I think it's usually a good thing. I know a lot of Wall Streeters don't really love that, but I think it's a pretty good thing. All right, so that's about it for me. Other than, I got to go over the disclaimer. As we always do, please take a moment to go over this, read over it, because there are risks to trading, and we explain all of that here. So please take a moment to go over that. I'm not trying to get you guys living off the cliff with me. I'm here to educate you guys on how to trade options around your own assumption. You don't have to follow my assumptions. All right, so if you can't take that, take it easy.